Hey guys, it's Realtor Adele, your favorite realtor and investment property strategist. Welcome to the Housing Market Report for the final quarter of 2022. This year, the housing headlines have been all about interest rates, inflation, and home prices. In this fourth quarter, these headlines remain the same. In this video, we're going to briefly revisit each of those topics to determine where we are right now and also highlight what we can expect for the housing market in 2023. Let's start with mortgages and this quote from Lawrence Yun, Chief Economist for the National Association of Realtors. Lawrence says that a return to a normal spread between the government borrowing rate and the home purchase borrowing rate will bring the 30-year mortgage rates down to around 6%. This is good news for both home buyers and sellers. Some home buyers have been priced out of the market due to elevated mortgage rates that have made purchasing a home unaffordable. As a result, some buyers have delayed their home purchase endeavors. This is also good news for sellers because sellers are seeing longer days on market as a result of a stall in the marketplace. This chart shows the 10-year treasury yield and the 30-year fixed mortgage rate and the average spread of 1.7. Now, mortgage rates tend to follow the 10-year treasury yield. So if you want to know where mortgage rates are trending or where they're slated to go, I suggest taking a look at the 10-year treasury yield. Now, a survey was done or research was done, and it was shown that for almost 50 years, the 30-year mortgage rate has moved in unison with the 10-year treasury yield. Here's another chart. So here's another chart with the spread and the 10-year treasury yield. You will notice that the spread is in orange and then the yield is in aqua. And the spread is the difference between the mortgage rate and the 10-year yield. So the first column between 2000 and 2021, you will notice that the spread was 1.79 and the yield was 3.49. And if you add those together, it gives you 5.28. The middle, or today, now this chart is for December 1st. There is a slight delay in some of these charts due to the fact that we want to allow for all of the data to come in. So the middle chart shows what the mortgage rate was as of December 1st when you add those two numbers together, 6.49. The third column is telling you what the mortgage rate would have been if it was a normal spread. So this is what Lawrence Yun was referencing when he said that we will return to a normal spread in the future, meaning that rates will end up around 6%. And why this has happened. So investors are charging a premium for mortgage rates, or they were, and this is all due to inflation. So the Fed's goal is to tame or slow down inflation. And in order to do that, interest rates or mortgage rates are elevated, making home ownership unaffordable. It's kind of, what do I want to say? It seems counterproductive. However, I guess it's a necessary evil to raise rates or to slow or tame inflation. And the feds do that by influencing mortgage rates. So mortgage rates are elevated, and slowly but surely homes become unaffordable. Buyers take a sideline or they delay their home purchase, which slows down the housing marketplace. I am no, what do I want to say? So I'm not a mortgage or financial expert. I'm just sharing this information with you to give you an idea or an understanding of how mortgages or the 30-year fixed rate mortgages tend to work. So again, mortgage rates, the feds do not determine mortgage rates, but they do influence it. And mortgage rates tend to follow the 10-year treasury yield. So if you want to know where mortgage rates are likely to trend, follow the 10-year treasury yield. So here is a look at the local market update for the Greater Atlanta area or Metro Atlanta. And this report includes the following counties: Cherokee, Clayton, Cobb, DeKalb, Douglas, Fayette, Forsyth, Fulton, Gwinnett, Rockdale, and Paulding counties. And this is not an error. This information is as of the end of November 2022. Again, some of these charts, there is a bit of a lag time to allow for all of the data to be recorded. For instance, if a home is sold or when a home sells and closes, the information is not recorded at the same time at the county level. So the change in ownership does not show on the tax records right away. And as a result, as mentioned, just want to allow for all of the data to be collected. So you will note so how this chart is divided. The top part is for residential detached, single family. The bottom part is for residential attached, meaning townhomes and condos. Please note the highlighted metrics. So closed sales, if you're looking from the top part of this chart, the closed sales under residential detached, go to that first middle column. It was just over 3,000 units. Days on market until sale, so right under that, days on market until sale was 33. The average, I'm going to skip the median just so you are aware. Median to me doesn't hold much weight. Median means if we have 7 homes, they find the middle one. So 3 on top, 3 on bottom. They find the middle home, and whatever that price is, that's the median. Average is where actual math is done, where they add up those or the cost or price of those homes and then divide it by the amount of homes sold, giving you the average purchase price. So average purchase price or sales price was 486 $295. That's an increase of 4%. Just under that, percentage or percent of list price received, 98.1. Why that's important is because we're seeing that sellers are receiving just over 98% of their asking price. Then we're going to skip the other one, the last one, where the star or metric is highlighted. Months of inventory for sale for single family detached homes was just over 2 months, so 2.3. Months of month supply of inventory is very important because it tells us if we're in a buyer's market or seller's market. Of course, so a seller's market is one in where we have less than 4 months supply of inventory, meaning that market conditions are favorable or more favorable for sellers. A balanced market would be that in which the inventory is closer to 6 months. If you have 6 months or higher, then market conditions are more favorable for buyers, and we are in a buyer's market. That determines the type of market that we're in. For the lower part of the chart, attached homes closed sales were 881 units. Now, closed sales, that's also important to consider because Not every home or property that goes under contract makes it to the closing table. So this number means that these are homes that actually went under contract and made it to the closing table, and um, title was transferred to a new owner. Days on market until sale 27. Average sales price 370,136. Percent of list price received 98.5. So that's a bit higher than the detached. Month supply of inventory 1.9. So that's even less than the single family detached homes. Again, this tells us that we are very much in a seller's market in the greater Atlanta area. This chart shows us the home price forecast or projection for 2023 from the various housing experts. Now, the column to you will notice that the three red columns, those show that these particular, or should I say, these particular agencies, they are predicting that home price appreciation will decrease in 2023. And you can see the numbers listed here. And then the ones in blue, they are projecting that home price appreciation will increase. You can see the numbers here: 0.7, 1.2, 2.6, 5.4. They have a projection that home price appreciation will increase. Now, these are lower than last year's numbers, of course. And then the green column just shows you an average of all of these agencies, an average of all of these agencies' predictions. Now, this is national. These are national home price appreciation projections. Now you just notice what's going on in Atlanta. Remember that real estate is local, so these numbers will look different depending on each market. So each zip code or each neighborhood will have its own number, or its own, what do I want to say? It will have its own price appreciation. For instance, last year, the average home price appreciation for Metro Atlanta was about 21%. And we were higher than other markets. For 2023, I suspect that it will be the same due to the fact that we still have very low inventory. What drives prices? Supply and demand always drives prices. So whether that's in goods or services or products, housing is no different. Think of, for instance, when 2020, when the pandemic first, what do I want to say? When we were all publicly, or when the public was alerted about the pandemic, how due to low supply and high demand, everything skyrocketed. We are still experiencing inflation right now in products, in goods. And with housing, as mentioned, is no different. Supply and demand will always drive or determine prices. So low inventory, high buyer demand will result in elevated home prices. Now, of course, no one has a crystal ball. We have to see how this all plays out. But at the end of the day, all real estate is local. And I would implore you to get in touch with a local real estate professional in the neighborhood where the property of interest for you is located, and get those numbers that pertain to that neighborhood. In closing, here is a quote from Doug Duncan, Senior VP and Chief Economist for Fannie Mae. Doug says, from our perspective, the good news is that demographics remain favorable for housing, so the sector appears well positioned to help lead the economy out of what we expect to be a brief recession. Now, for most people, when they hear the word recession, they're automatically jolted back to 2008, where we experienced a major housing crisis. This time around, it's much different. And of course, this is not to take, I don't want to take this lightly because back then, many people lost their jobs, they lost their homes, and that was not a good time for the economy or people collectively because you were affected directly or indirectly, and that spanned over a period of years. So, but I feel that when most people hear that word, and rightly so, we're automatically jolted to 2008. But this time is different due to the fact that lending standards or practices are much tighter or have tightened. Also, we have very much, or what do I want to say? We don't have as much inventory in the marketplace as we did back then. I just showed you in Metro Atlanta that we have around 2 months of inventory, which tells us that inventory is still historically low and overall there's still a high buyer demand. Yes, the market has stalled. So, what is recession? The word recession really means slow down. Why is there a slowdown? Well, elevated home prices and interest rates more than doubled this year and in less than a year. So in over 50 years, we had not seen interest mortgage rates more than double in less than a year. As a result of this, as a result of that, home buyers have delayed, or some home buyers have delayed their purchase. There's been a stall in home sales due to the fact that housing is no longer affordable as it was before due to that dynamics of elevated home prices, elevated mortgage rates makes housing unaffordable for most people. And isn't that the Fed's goal? The Fed's goal is to tame or slow inflation. This is not sustainable. We can't continue to, like, I've never seen home prices this elevated and so quickly. And I was a realtor in 2008. I was 2 years in. So I've experienced what that was like back then and over time. So, what I want to say is that a slowdown is expected. It's a little bit of a necessary evil. And I mean that in the best way because elevated home prices and elevated um, mortgage rates, inflation overall is not sustainable for the collective. Something has to be done. So, in an effort to tame or slow down this continuous volatility, the Feds are trying to bring stabilization and balance back to the market. That can only be done by making rates unaffordable, like spiking rates. Now, of course, Lawrence Yun stated that we will see mortgage rates start to balance out. So we are starting to head in the opposite direction, and that is good. No one has a crystal ball, but hopefully we've seen the peak for interest rates. And now that we've seen this peak, it's time to head in the opposite direction. I also want to reference that previous slide in terms of home price appreciation. Um, So appreciation, or should I say home prices, there has been some headlines in the marketplace, and I implore you to please read beyond the headlines, because I feel that sometimes we can look at a headline and come to a determination or make a decision based on that headline instead of reading the details. A lot of the headlines are clickbait situations. So um, I encourage you to read the details of headlines that you are seeing. But to wrap this up, a recession or slowdown is necessary. And in my opinion, we are not going to see what we all experienced in 2008. Market conditions are completely different now than they were back then. And so there have been some headlines stating home price deceleration. Note that deceleration does not mean depreciation. Depreciation is a loss in value. Deceleration is just at a lower rate. So we are going to see, or should I say, experts have predicted a slight home price appreciation for 2023. Again, if you see headlines that reference home price deceleration, that is not depreciation, that is not lost in value. What determines value? What determines value? If there is a low supply and high buyer demand, that is what will drive prices. So again, each market is different. Real estate is local, and I will leave it there, my friends. To summarize, mortgage rates are slowly going down. Rates tend to follow the 10-year treasury yield. Supply and demand determine home prices. Home sales have slowed, however, we are still very much in a seller's market. With that said, all real estate is local, but we are in a seller's market in most neighborhoods. With rates expected to stabilize, this will bring home buyers back into the market, lifting that slight stall that we are experiencing. A brief recession or slowdown is expected as the Feds aim to tame inflation and bring stabilization and balance back to the market. This is not a repeat. I repeat, it's not a repeat of 2008. Inventory is still historically low, and today's homeowners have a healthy amount of equity in their homes. As always, it's my goal to provide you with accurate information from trusted sources so that you can make the best decisions for yourself and your family. I wish you a safe, healthy, and blessed end of 2022. My very best for the coming year, and much success in your real estate endeavors. That's all for now. Until next time, take good care.